capital raising, it's getting more and more difficult, certainly since you and I probably started in this world.
Retailization has been a buzzword for a number of years, obviously, but it's been picking up pace for sure.
So I completely agree with that. I think there's definitely deals out there, there's opportunities out there. It is just navigating the landscape to get to them.
The fundraising market still has its challenges, especially for the smaller managers, but as we've said, the GPs are nimble and they are looking at different pools, whether that's through the retailization stuff we were talking about, whether it's looking at ERISA money and having bespoke products there, or it's managed accounts or funds of one, whatever it is, there are deals out there that need to be done and private capital will have to do them.
Welcome to MUFG Alt Insider, brought to you by MUFG Investor Services. Get ready to explore the latest industry trends and gain invaluable perspectives from partners across our expansive global alternative investment management ecosystem.
Hello, welcome to MUFG Alt Insider podcast. My name is Sonia Bhasin and I am the General Counsel at MUFG Investor Services. I am very pleased today to be joined by John Adams. John is a partner in the funds section of A&O Shearman in London, and is actually someone I have had the pleasure of knowing throughout my career, actually since law school. So as well as being obviously a partner in this world, I'm also very pleased to say that he's a friend. John, over to you to say a little bit about you and your background.
Oh, thanks, Sonia. Straight back at you. Yeah, no, it's been a pleasure knowing you, and it's a pleasure to be here joining you for today. So yeah, I was, I guess, a partner at Shearman and Sterling before the merger, and so now I'm a partner at A&O Shearman, sitting in the London office, focusing on all things to do with funds and setting them up, operating them, and working with investors as well. And that's
Fabulous.
Me.
Thank you, John. So I thought today it would be great to talk a little bit about marketing, a little bit about what we're seeing in the market and how people are actually accessing and capital raising. It's getting more and more difficult, certainly since you and I probably started in this world, John. So I think that would be a great thing for us to kind of focus on. Perhaps we could start with retailization and what you're seeing in this space. I know this is an area of growth for managers in the private space, and obviously it covers a lot of LTIFs, LTAFs, other structures, of course, but it'd be great to see what you're seeing and what trends that come up a lot with you. And also, I think just to see what is an access fund. This means different things to so many different people. So it'd be great for your take on that.
All right, there's quite a lot to unpack there. Sounds good. Right, so retailization has been a buzzword for a number of years, obviously, but it's been picking up pace for sure. I suppose at its core, retailization is about what we think of as traditional private fund investment strategies, those that focus on more illiquid assets like private equity, credit, real estate, and so on, being made available to retail investors on the basis that, I guess from the investor side, the retail investors should have access to those sorts of strategies. And from the manager's side, it should be win-win as well, because they potentially get access to these pools of capital that they've just not traditionally dipped into. And for investors, why would they be interested in these kind of historically institutional strategies? Well, they get to diversify their portfolios into new asset classes, and everyone loves diversification. They have their capital managed by the brightest and best, and possibly thereby they get greater investment returns, right? So it should be, as I say, a win-win for managers and investors. And I suppose the context is that fundraising, it's no secret, fundraising hasn't been the best for traditional funds over the last couple of years. And so, targeting this new capital from a GP's perspective, from a manager's perspective, makes a whole lot of sense. And if it works for the investor, which it can very well do, then that's just fantastic.
We get a lot of inquiries from our clients on LTIFs and LTAFs, John. That seems to be an area of focus.
I wish they didn't sound so similar, right?
They really do. So are those structures that you are seeing are growing in popularity, or are there other structures that people are now preferring? Obviously, this market moves so quickly.
Yeah, absolutely. There are so many different types of vehicle that I guess would fall under the umbrella of being used in the context of accessing retail capital. I mean, historically, like from a policy perspective, obviously the idea has been that you've got to treat retail investors very paternalistically and they should be exposed to simple assets, not much risk. You can get your money back quickly if you need it. So it's sort of very much a safety first approach. But as it's been recognized that investors need access or ought to be given the opportunity to have access while still having protections sort of around that to these institutional type strategies, we've had these new specific vehicles like the LTIF and the LTAF that have been designed quite specifically for targeting retail investors. They don't have to be targeted at retail investors, but that's kind of the whole genesis of them and the reason in large part for them existing. And that's obviously in the EU and the UK. So in the EU, we have the European Long-Term Investment Fund, the LTIF, and then we have the Long-Term Asset Fund in the UK. And even though they sound very similar, and they're trying to achieve similar things in terms of the access for retail investors, but they're very, very different products with totally different rules that apply to them, different marketing consequences, different authorization regimes, and so on. So they are nascent. They are quite recent beasts, but they are picking up a pace, that is for sure. And in the US, we also have vehicles that are kind of increasingly being used for something similar. So in the US, the retail market is in registered investment companies, regulated funds, and there are a bunch of different types of investment company that can be used to hold illiquid assets and give retail investors exposure to them. But recently, interval funds, which are a type of investment company that allows an investor to redeem at specific intervals, like quarterly or annually or whatever, and tender offer funds, which are kind of similar, but then there's a repurchasing of investors' interests, which is done periodically at the sort of discretion of the governing body. Those have very much been leapt on as vehicles of choice for accessing this retail capital. And then, honestly, I could ramble on for a long time about other types of vehicles that are used for retail investors. There are feeder funds that are created specifically to pool the capital of smaller investors. And then you take that feeder fund and you invest into a sort of more traditionally institutional master fund. And that feeder fund might be going around private bank clients, for example, and accumulating all smaller investments altogether so that you end up with a big number in the end. There are listed funds. There's a whole range of vehicles. And as I say, GPs are nimble. So when they see that the market is challenging for fundraising generally, they come up with solutions in conjunction with their advisors and their friends. And these are the types of vehicles that are used. Have you seen that too?
We have. We're definitely seeing opportunities from various jurisdictions, as you say, the UK, Europe, and even inquiries from the US. It doesn't seem to be, certainly from my perspective, it doesn't seem to be concentrated in any one market at this stage. I think, as you say, it very much depends on where the target investor is. Would you agree with that? Or are you seeing a particular market sort of jumping above the others?
Like all these things, the target investors are absolutely critical, especially when, for some managers entering this space, it's a brave new world, because if a manager's historically only managed private funds, so-called unregulated funds, then it will be used to its investment strategy that just being something that's like a contractual negotiation between them and the LPs. And, there may or may not be concentration limits or limits on borrowing or investment restrictions relating to like the types of assets that can be acquired, but it's all contractually negotiated. But with these vehicles, some of that stuff is written into hard and fast rules. And so a manager has to recognize that, it will be operationally constrained to some extent in an LTIF or in an LTAF. It might suddenly find that it can invest a maximum amount of its capital in one single asset set at sort of 20%, or borrowing is capped at 30% or whatever. So it is a new world, and that's quite apart from the kind of regulatory application stuff, because these funds can take many, many months to get into place and involve, new compliance procedures, potentially even changes to your regulatory status. And, I'm not saying it's a no-go area. Plenty of people are doing it, but you have to go into the process with your eyes open, I guess is what I'm saying.
Are you seeing much flexibility from the regulators around this? I mean, we obviously all know there are rules and regulations that need to be followed, but historically, where we had AIFMD, we had UCITS, it became very common, certainly from what I was seeing, that we would go to regulators and ask for derogations from certain of those things. Are we at that point with these yet, or is it still, it's a yes or it's a no?
Yeah, I think it's super early, and unfortunately, the nature of European legislation, in my view, over the years, certainly you're totally right. Back in the day when every hedge fund manager around the world was looking at UCITS and thinking, how can I squeeze my strategy into this UCITS? You had, Ireland was out there as a relative newcomer. I really am showing my age and therefore your age, Sonia, by talking about this.
Thanks, John.
But, Ireland was a relative newcomer into the world of trying to be, a preeminent fund domicile, and was particularly flexible at a certain period of time. I think the development has been over the years to just have more in specific kind of rules that exist. And some of these are really quite hard and fast restrictions on what an LTIF can do and an LTAF can do. And I think it's too early to see people just sort of regulators shrugging their shoulders and saying, yeah, we don't mind, you go off and do that.
Yeah, I think that makes sense. I think certainly regulators, just in general, not even on this subject, are taking a much more stringent view on things these days. Again, we're clearly far too old for this. But
well,
we are
maybe
definitely seeing a
change.
different scope and attitude, I think, as well. So whilst we're obviously staying on fundraising and how managers are actually raising capital, are you seeing a lot of co-invest managed accounts still being used? I know certainly, 15 years ago, managed account was the buzzword. So are you still seeing things like co-invests or managed accounts, or even that interesting term sidecar?
Yeah, no, it's a good question. Yeah, very much so, to be honest. Yeah, sidecars. I mean, the term can be used to describe different things, but sometimes people use the sidecar to mean just an AIV that's set up to deal with a specific investor's issue, sort of alongside a fund. Sometimes you're talking about kind of a single asset vehicle that's established just for one investment opportunity, like a club deal. But yeah, they've been around forever and they continue to get done all the time. Co-investments can be attractive for a whole bunch of reasons, and these club deals can as well, because even though it might be challenging for raising capital for a commingled fund, at least for some managers, the deals are still there. I mean, there are deals that are out there that still need to be done. So, sidecars, single asset vehicles, or co-investments in the context of a vehicle that actually sits alongside the main sort of flagship fund and takes the kind of over allocation, which can't be or isn't appropriate to be slotted into the main fund. They're going on all the time still. What I have noticed, I'd say, on co-investments is that the timeline seems to have just gotten more and more truncated. I don't know if you've seen this too, but investors are being told they have to move quickly because the GP is being told it has to move quickly on the deal. And so you don't have the luxury of, or not as much anyway, you don't have the luxury of finding the opportunity, going out to investors, sitting back, having a cup of tea, taking your time, thinking about it, then deciding, right, we better start getting the lawyers involved to draft the documentation, considering all of the investors' different characteristics that might mean you need extra blockers or whatever for tax reasons in the structure. A lot of that can be front loaded now. And so I'm seeing more and more, I guess, the co-investment structures essentially being prepared, and in some cases with strategic investors, like negotiated in advance of any opportunity coming up at all, which is, it works fantastically for everyone when an opportunity eventually comes along. But clearly it takes time and there's effort up front, which has to be put in. But yeah, those deals, there are still deals that need to be done.
Yeah, and those pre-conversations are super helpful, I guess, because you're right, the deals need to be done, and once they're at that point, but those pre-conversations, that early upfront work is definitely very cohesive to getting it off the ground.
Yeah, no, completely agree.
So for managers, so assuming people have worked out what structure they want, and we've talked about the various structures here.
Yeah.
The difficult thing, of course, is marketing. And I feel marketing has got harder and harder over the years. We all love and hate the term reverse solicitation. Do you see people still relying on reverse solicitation, or is there more focus on fund registrations? What are you actually seeing? And also in terms of kind of pre-marketing, how does that interact with reverse solicitation?
Yeah, so reverse solicitation for someone like me,
Horrible term, right?
huh?
It's a horrible
Horrible
term.
Well, when I was growing up, I couldn't really have dreamt that I would use the phrase reverse solicitation as much as I have in adult life. It's quite amazing. But going back to the kind of proposal for AIFMD back in 2009, and I remember being very closely following the development of that. I know you did too. And there originally wasn't going to be a concept of reverse solicitation, but the reality was that there are big investors out there that were saying, well, hang on, we've got great investment teams, and that we've got people that literally we employ to go out and seek out the best funds for us to invest in. So, you can't stop us doing that. That's a terrible thing. And so we've got this concept of reverse solicitation in the EU. Are people still relying on it? I mean, yes. And the basic rule of thumb hasn't changed, I don't think, when it comes to reverse solicitation. It is not a marketing strategy. You can't say we are going to target capital in the EU by reverse soliciting. That's just a kind of a contradiction in terms. And it's not a globally recognized concept. I mean, I'm focusing on sort of Europe here, including the UK. But there are countries where reverse solicitation just is not recognized, and that's important to bear in mind. So unfortunately, like many things in the marketing world, you have to look at things on a kind of country by country basis, which, people don't always want to hear, but unfortunately it is true. Are there grey areas where it's not a slam dunk as to whether the circumstances kind of leading up to the investment are clear-cut reverse inquiry? Yeah, of course, it happens all the time. And that's, I guess, when you get advisors to help assess the facts and all the rest of it. And clearly a paper trail is super, super important. You've got to document these things properly. Its interaction with pre-marketing in the EU is really interesting. And it is the EU. The UK is a completely different kettle of fish when it comes to pre-marketing. But yeah, the two things interact a great deal, because in principle, if a manager pre-markets in an EU country to test the water, which it often wants to do, then it has to accept that if it ultimately does get an investor within the next 18 months, then that will be treated as proper marketing. And it will be assumed that the investor only came in because of your pre-marketing activity. So you have to upgrade to full marketing. And that has two consequences, I guess. One is that you can only take that investor in after doing full registration, full marketing in that country, and you cannot rely on reverse solicitation. So it doesn't matter if it's you go and you speak to one investor in France and test the water, and then there's an out of the blue inquiry from an entirely different investor in France. 6 months later, that will be assumed to have been a result of your pre-marketing activity, and you have to register. And that has huge consequences for a non-EU manager. And apologies for me going on, but I've had this conversation so many times about pre-marketing where people say we want to register for pre-marketing. Where? Everywhere. Well, in some EU countries, full registration for marketing by a non-EU manager is just not possible. Or it is theoretically possible, but it's not viable in practice. And so there is literally 0 point in pre-marketing there. It's like the worst of all worlds in that scenario, because you either need an EU authorized AIFM so you can market properly in the EU, or you don't pre-market, because you won't be able to take in an investor through full marketing because you can't register there, or it's impractical. And you can't take someone in through reverse solicitation because you've pre-marketed. So you're just completely straitjacketed. So yeah, they interact together very closely. Reverse solicitation has definitely, I would say, gotten harder in the EU because of all of the pre-marketing rules. The UK is different. The UK is great. There's definitely more that can be done in the UK to test the waters.
Definitely a very delicate balancing act in terms of when you start, which route you want to go. pre-marketing, reverse solicitation. And as you say, if you can never get to the full marketing and registration, then you really need to rethink that strategy.
You're absolutely right. It's like a cost benefit analysis, basically per country. Like you say, you want to go into this country. Well, don't do that, because if you pre-market there, you're not going to have any investors over the next 18 months because you won't be able to market formally and you won't be able to reverse solicit. You want to go and pre-market here. Well, that's fine, but these are the consequences. And realistically, what sort of tickets are you expecting in that jurisdiction? So you have to walk through this on a country by country basis and really think about your strategy. I know the temptation is to just want to test the water everywhere, but you can end up tripping yourself up if you do that. But yeah, what about you? Reverse solicitation, have you seen it?
We get a lot of inquiries
away?
actually around it, yes. And I know certainly it is becoming more and more difficult, which is sort of really why I wanted your thoughts on this. We are still seeing people trying to rely on it across the board, really. So it's interesting. And certainly from my perspective, how it interacts with pre-marketing is super interesting. Because it is, as we say, it's that delicate timeline in terms of how you do this, why you do this, and what are you going to achieve at the end of it.
Yeah, and particularly when people are seeking out capital and maybe thinking about different jurisdictions that they haven't gone to before and seeking capital there. So sort of similar point to the retailization, even if it's purely institutional and you're thinking, well, maybe we want to try that country or that country or that country where we haven't tapped things and we've got some relationships historically there. When times are challenging elsewhere, then, as I say, GPs look for capital elsewhere, and this is all super important to them. You got to get it right as well, because at least in theory, if you get it wrong, depending on the country, you could be breaching the law or regulation. In some countries, it can be a criminal offence. Although, I'm not aware anyone's ever gone to jail for it, but it's technically a criminal offence. And in some countries, there's at least a theoretical possibility of the investor having a right to rescind as well, So You've got to get it right.
Yeah. So I think when we opened, we did mention how capital raising is becoming more and more difficult in terms of the surrounding factors, regulation, investors, how they now think of this. How are you seeing capital raising evolving for the remainder of this year, 2025, and into 2026?
Wow, crystal ball. I mean, the first half of 2025 was actually, there were genuinely some kind of green shoots. I think the data shows that funds that got to closing were generally doing so quicker than they had done maybe in the last couple of years. So that sounds good and looks good, although I think there were also fewer funds that closed. So you can interpret, there are statistics and damn statistics, right? But it looks promising in some ways. There are green shoots, and anecdotally, we're still launching funds. There are funds launching, there are funds closing, and people are getting there. So I'm a super optimistic person. I'm not going to, unfortunately, stick my neck out for 2026. It's hard enough to predict what's going to happen next week in this world, let alone next year. Yeah, but the fundraising market still has its challenges, especially for the smaller managers. But as we've said, the GPs are nimble and they are looking at different pools, whether that's through the retailization stuff we were talking about, whether it's looking at ERISA money and having bespoke products there, or it's managed accounts or funds of one, whatever it is, there are deals out there that need to be done, and private capital will have to do them. So, yeah, I'm optimistic. I'm an optimist anyway, so as are you, right?
Absolutely. Yeah, so I completely agree with that. I think there's definitely deals out there, there's opportunities out there. It is just navigating the landscape to get to them.
Yeah.
Thank you so much, John. It's been an absolute pleasure to have you on the MUFG Alt Insider podcast. And certainly from my perspective, being able to chat to a friend always makes a difference as well. So thank you so much for your time. We really appreciate it.
Oh, it's my absolute pleasure. And it always is. Thank you, Sonia. Thank you, MUFG Investor Services.
Thanks for listening to MUFG Alt Insider. Don't miss out on future episodes. Subscribe to receive them directly to your inbox as soon as they're available. Visit www.mufginvestorservices.com/altinsider.